Welcome to the Property Wealth Podcast. Today, we're diving into a topic that's really exciting for those looking to build long-term wealth through real estate, the sweet spot of small multifamily properties, specifically those 2 to 4 units.
Yeah, Sarah, these properties often fly under the radar, but can be such a powerful tool for investors, especially for those of us over 40 who are thinking about retirement and long-term financial security.
Absolutely. It's all about creating that passive income stream, right? We'll talk about why these smaller units can be a great entry point into real estate investing, the benefits of managing fewer tenants, and how they can really help you build equity over time.
And we'll also touch on some practical tips for finding the right properties, as well as financing options that might be available. It's about making informed decisions that lead to sustainable wealth.
Right. Plus, we'll share some personal stories and insights from our own experiences in the market, which I think will really resonate with our listeners.
Yes, real-life examples can make a huge difference, They help to illustrate the principles we're talking about in a relatable way.
Exactly. So let's get right into it. What do you think is the first thing someone should consider when looking at small multifamily properties?
Sarah, it's really interesting to see how the landscape of real estate investing has shifted, especially for those of us over 40. I've talked to so many investors lately who are feeling the pressure of retirement timelines looming over them.
Absolutely, Mike. I think a lot of people in that age group are starting to realize that they need to make their money work for them, like really work for them. With inflation creeping up, it's even more crucial to find solid investments that can keep pace, right?
Exactly. I remember speaking with a client, let's call him Tom. He was in his early 50s and had been primarily focused on a traditional retirement plan, the 401k route. But as he started to see the numbers, he realized that, it just wasn't going to cut it.
Right, and with inflation, that retirement nest egg could shrink faster than people realize. What did Tom end up doing?
He shifted his focus to small multifamily properties. He found a 4-unit building in a growing neighborhood. The cash flow from those units really helped him supplement his retirement income. Plus, it provided a hedge against inflation. Real estate tends to appreciate over time, right?
Yeah, and that's such a smart move. Not only does he have that steady cash flow, but he's also building equity. I think it's empowering for people to realize they can be proactive about their financial futures, especially when they see the potential for wealth transfer to their families.
Exactly. I've seen families create generational wealth through real estate. Take Lisa, for instance. She's in her late 40s and invested in a duplex. Her plan is to eventually pass that property on to her kids. It gives her peace of mind knowing that, she's not just investing for herself, but for her family's future.
That's so important. And it's not just about the numbers, right? It's the emotional side of financial security that makes such a difference. Having that property not only benefits her financially, but also creates a legacy for her children.
Absolutely. And let's not forget about the current economic trends too. With the market shifting, more people are looking for affordable housing options, especially as home prices continue to rise. Small multifamily units can often fill that gap, making them a smart investment.
Yeah, I think a lot of people overlook that aspect. They see the bigger single-family homes and think that's the only way to go. But small multifamily properties can really cater to a growing market, especially for younger renters who want to live in desirable areas without breaking the bank.
Right, and that creates a steady demand for those smaller units. I spoke with another investor, let's say her name is Karen. She purchased a triplex in a college town. The demand for rental properties there is consistently high, particularly from students.
That sounds like a smart investment. The turnover might be a little higher with students, but it also means she can easily adjust rents annually, right?
Exactly. And with some strategic management, she's even able to keep some of the same tenants year after year, which can help with stability. Plus, she's building equity as the property appreciates.
I love that. It's like a win-win situation. And let's be real, people over 40, they're not just looking for a way to make money. They want to feel secure. They want to know that they've made the right choices for their futures.
For sure. I think that emotional security is something we can't overlook. It's not just about the numbers. It's about how those investments make you feel. Knowing that you have a reliable income stream, that you're building something tangible, it gives people a sense of control.
And with the uncertainty in the economy lately, having that kind of control is more important than ever. I mean, we hear so much about market fluctuations and job security. Real estate can be a stabilizing force in a lot of people's lives.
Exactly. And when you're investing in small multifamily properties, you can often manage those risks better. If one tenant moves out, you still have income coming from the other units. It's like a built-in safety net.
Right, and that's crucial for folks who might be nearing retirement age. They can't afford to have their income drop suddenly.
Yes, and I think it's important to highlight that this isn't just a strategy for the ultra-wealthy. Small multifamily properties can be accessible for a lot of people, especially if you start small and scale up over time.
Totally. It's about taking that first step, right? Even if it means starting with a duplex or a triplex, that can set the stage for future investment.
Exactly. And as people build their portfolio, they often find that they gain confidence and experience along the way. It's a journey, and it doesn't have to happen overnight.
Yes, and with the right mindset, they can turn those small steps into something significant. It's all about creating a path that works for them.
Well said, Sarah, and I think that's a great segue into discussing some core strategies for finding and managing small multifamily properties. So, when we're talking about small multifamily properties, like those 2 to 4 units, there are some solid strategies and rules of thumb that can really help guide your decisions, right?
Absolutely, Mike. One of the first things that comes to mind is the 1% rule. Can you break that down for us?
Sure. The 1% rule is pretty straightforward. It suggests that the monthly rent you can expect to collect should be at least 1% of the purchase price of the property. So, if you buy a property for $200,000, you should aim for at least $2,000 in monthly rent.
That makes sense. It's a quick way to gauge if a property is worth your time, but, it's not the only thing to consider, right?
Exactly. It's a good starting point. But you also have to think about other factors like operating expenses. That's where the 50% rule comes in. It's a way to estimate your expenses.
Right. The 50% rule. So if you're estimating your gross rental income, you can assume that about 50% of it will go toward expenses, like maintenance, property management, and taxes.
Yep, that's right. So if you're projecting $2,000 in rent, you might expect $1,000 to go toward expenses. That leaves you with a net income of $1,000, which is a more realistic picture of your cash flow.
And that's crucial, especially for newer investors. Cash flow is king, right?
Absolutely. You want to ensure that your cash flow can cover your mortgage payments and still provide you with some profit.
Speaking of mortgages, let's chat about financing options. What do you recommend for folks looking to invest in small multifamily properties?
Well, traditional loans are often the go-to, especially if you're looking for a lower down payment. FHA loans can be a great option for first-time buyers, allowing you to put down as little as 3.5%. Which is pretty appealing.
Right, and that's especially helpful for someone just starting out. But how does that affect their overall investment strategy?
Good question. With a lower down payment, you're leveraging more debt, which can amplify both your returns and your risks. If the property appreciates, that's great. But if it doesn't, you could be left with a larger mortgage than the property is worth.
So it's a bit of a double-edged sword. What about other financing options, like commercial loans?
Yes, commercial loans are another route, especially if you're looking at properties with more units or higher price points. They often have stricter requirements and can come with higher interest rates, but they also allow you to tap into larger properties.
And let's not forget about private money or hard money loans, right?
Exactly. Those can be good options if you need quick funding or if you're dealing with a property that needs some serious renovations. Just keep in mind that they usually come with higher interest rates, so you want to have a solid plan for how you'll pay them back.
That's a great point. Now, when evaluating a deal, what kind of checklist do you recommend?
I like to keep it simple. First, look at the location. Is it in a desirable area? Are there schools, shopping centers, and amenities nearby? Next, check the property condition. You don't want to get stuck with a money pit.
Yeah, and you should also consider the current rental market. Are there similar properties in the area? What are they renting for?
Exactly, and then there's the potential for rent increases. You want to know if you can raise rents in the future, especially if you're making improvements.
So once you've assessed the property's potential, how do you determine whether it's a good investment?
That's where cap rates come into play. The capitalization rate is a ratio that compares the net operating income to the property value. A simple formula would be, divide your net operating income by the property price.
And what kind of cap rate should investors be looking for?
Generally, a cap rate of around 8% to 10% is considered good in many markets, but it can vary based on location and property type. Higher cap rates usually indicate higher risk.
That's a helpful benchmark. And it's important to remember, too, that what's considered a good cap rate can change over time with market conditions.
Absolutely. And don't forget to factor in your exit strategy. What's your plan for the property in the long run? Are you looking to hold it for cash flow? Or do you have plans to sell it after a certain appreciation?
Right, having that end goal in mind can really shape your investment strategy.
For sure. And let's not overlook the importance of understanding the local market trends. You need to be aware of what's happening in your area. Job growth, population growth, and economic indicators.
Those can really influence both property values and rental demand. So what happens if you find a property that looks good on paper, but still gives you a gut feeling that something's off?
Trust your instincts. If it feels wrong, it's okay to walk away. There are always other opportunities out there.
Definitely. So these strategies and rules of thumb are great, but we should transition into some common pitfalls that investors should watch out for.
Oh, for sure. There are definitely some missteps that can trip up even seasoned investors. Let's dive into those next. So let's dive into some of those common pitfalls that people face when investing in small, multifamily properties. You know, it's easy to get swept up in the excitement, but there are definitely some things to watch out for.
Absolutely, Mike. I think one of the biggest mistakes is over-leveraging. People see their friends or neighbors making money in real estate and think they can do the same by borrowing more than they can handle, right?
Exactly. I once had a client who jumped into a 4-unit property, and they were so eager to leverage themselves that they took on a mortgage they really couldn't afford. When unexpected repairs came up, like a roof that needed replacing, they just didn't have the cash flow to cover it. It quickly spiraled into a nightmare.
Wow, that's a tough situation. So it sounds like cash flow is something we really need to emphasize. If you're not keeping an eye on that, you can end up in a lot of trouble.
Yeah, for sure. Cash flow is king. I always tell my clients to do their homework on the numbers before committing. You want to ensure that the rent covers all your expenses, including mortgage, taxes, maintenance, and a bit of a cushion for those unexpected costs.
Right, and that's where bad tenants come into play too, isn't it? If you're not screening properly, you could find yourself in a situation where you're not getting rent and having to cover those costs out of pocket.
Exactly. I had another case where a client didn't vet their tenants thoroughly. They skipped the background checks and ended up with a couple who didn't pay rent for 3 months. They had to go through the eviction process, which was costly and time-consuming. It's just not worth it.
That's such a good point. So what should investors look for when screening tenants?
Well, it's all about asking the right questions. Check their credit history, ask for previous landlord references, and sometimes even have a chat with them in person. You can get a good sense of their reliability just by having that interaction.
That makes sense. And what about the timing of the market? I know a lot of people try to time their investments based on market trends.
Oh, that's a big one. I've seen people wait too long, trying to predict the perfect moment to buy. They end up missing out on opportunities altogether. The truth is, it's often better to focus on your own financial readiness rather than trying to catch the market at its peak.
So focusing on your own strategy rather than the market noise is key.
Definitely. And let's not forget about hidden costs. Many new investors underestimate things like property management fees, maintenance costs, or even utilities that might not be included in the rent.
Yes, I think a lot of people overlook those. It's easy to get caught up in the excitement of acquiring a property and forget about all the little things that can add up.
Right. I had a friend who bought a duplex thinking it would be a great passive income source. They didn't account for the fact that one side would need extensive renovations. They ended up losing money for the first year instead of generating income.
That's a real eye-opener. It's crucial to do a thorough inspection and, if possible, have a professional look at the property before closing, right?
Exactly. Get a solid inspection done, and if the inspector highlights any potential issues, factor those into your budget. It's better to know upfront than to be blindsided later.
And I think it's worth mentioning the importance of having a financial buffer. If you can set aside some cash for emergencies or unexpected expenses, it'll save you a lot of stress down the road.
Yes, having that financial cushion can make all the difference. It gives you peace of mind knowing you're prepared for whatever comes your way.
So let's talk about how someone can spot these red flags early on. What advice do you have for investors to avoid these common pitfalls?
First, do your due diligence. Research the market and really understand the neighborhood. If you're not familiar with the area, spend some time there. Talk to locals. Check out the amenities and see how the property fits into the overall landscape.
That's really important. Getting that local insight can help you gauge whether it's a good investment or not.
And don't rush into decisions. Take your time to analyze the numbers. If something feels off, it probably is. Trust your gut, and don't be afraid to walk away if the deal doesn't meet your criteria.
That's a great reminder. And what about networking? I think connecting with other investors or joining local real estate groups can be really beneficial.
Absolutely. Networking is invaluable. You can learn so much from others, experiences. They can share the mistakes they've made, which can help you avoid making the same ones. Plus, you might find potential partners or mentors along the way.
Right, learning from others can save you a lot of headaches. And keeping up with market trends through those connections can also help you make better decisions.
Exactly. You know, real estate investing is a journey, and it's about continuous learning and adapting. If you stay engaged and informed, you're setting yourself up for long-term success.
Yeah, and it's all about building that foundation. So for anyone who's listening and feeling a bit overwhelmed, just remember to take it step by step.
For sure. The important thing is to be proactive. Stay educated and don't let fear guide your decisions. Every experience, good or bad, is a stepping stone toward your financial goals.
That's such a positive way to look at it. All right, so what's the next step for someone who's ready to dive into small multifamily investing?
Start by assessing your financial situation, know your budget, and then research potential markets. Look for areas with good rental demand and growth potential.
And from there, it's about finding the right property and getting into the right mindset for success.
Exactly, and remember, it's a marathon, not a sprint. Take your time, do your homework, and you'll be on your way to building that wealth.
That's a great note to end on. It's all about being informed and making smart choices.
Absolutely. And just keep in mind that every investor started somewhere. And with the right approach, you can navigate these challenges effectively.
Thanks for all the insights today, Mike. It's always a pleasure to chat with you about property investing.
Likewise, Sarah. I hope our listeners feel more equipped to take on their investment journeys. All right, so let's dive into some immediate actionable steps that you can take right now, to get started with small multifamily properties.
Yeah, I love that. It's all about making progress, right? What's the first step?
Well, a great starting point is to familiarize yourself with the local market. Sites like Zillow can be super helpful. You can check out listings, get a feel for prices, and see what's available in your area.
Absolutely, and I think it's also important to look at the rental market. Understanding what rents are going for can really shape your investment strategy.
Exactly. That's where tools like Rentometer come in handy. You can get a quick sense of rental prices for specific neighborhoods. It helps you determine if a property could generate the cash flow you're looking for.
Right. And if you really want to dive deep into analyzing potential deals, I'd recommend the Bigger Pockets calculator or deal check. They make it easier to crunch the numbers and see if a property makes sense financially.
Yes. And don't forget about the local MLS or multiple listing service. If you can get access to that, it's a treasure trove of information about properties, their histories, and market trends.
And if someone's new to this, where should they start with those tools? It can be overwhelming.
Good point. Start small. Maybe pick one tool and really get to know it. For example, if you choose Zillow, spend some time just browsing listings and familiarizing yourself with the filters.
That makes sense. And it's a lot less daunting than trying to tackle everything at once.
Exactly. You want to build your confidence. And once you're comfortable with one tool, you can slowly introduce others into your routine.
What about habits? Are there any specific practices you'd recommend?
For sure. A great habit might be to analyze one deal per week. It doesn't have to be a big deal. Just something small you can practice with. This helps you get into the mindset of evaluating properties regularly.
I love that idea. It keeps you engaged without feeling overwhelmed. What else?
Joining a local real estate meetup can also be incredibly valuable. You can network, share experiences, and learn from others who are on the same journey.
Yes, and it's a great way to find mentors or even potential partners in your investing journey.
Exactly. And if there aren't any meetups nearby, you can look for online communities or forums. BiggerPockets has a fantastic community where you can ask questions and get advice.
That's a good point. Online communities can be just as supportive, especially if you can't find local options.
And don't forget to immerse yourself in learning. There are some fantastic books out there. The book on rental property investing by Brandon Turner is a great resource.
Oh, I've heard about that one. It's quite popular in the real estate community.
Yep, it's very practical. Another one I'd recommend is Real Estate Investing for Dummies. It covers a lot of ground and breaks things down nicely.
Those sound like good picks. Any podcasts you listen to that you'd recommend?
Definitely. Besides our own, of course. Chuckles. I'd say check out BiggerPockets podcast. They share real-life stories and tips from investors, which can be super inspiring.
That's a classic. And it's always refreshing to hear different perspectives on investing.
Absolutely. Remember, it's about starting where you are. You don't need to have it all figured out from the get-go.
Yeah, just take those small steps and build your knowledge and confidence over time.
And as you do that, you'll be amazed at how much you learn. Just keep pushing yourself a little further each week.
So it sounds like the key here is consistency, right?
Exactly. Whether it's analyzing deals, networking, or reading, consistency will really pay off in the long run.
With all these tools and habits in your pocket, you're ready to move forward. Let's recap what we've covered today.
So as we wrap up, let's quickly recap some key takeaways from our discussion on the small multifamily sweet spot.
Yeah, absolutely. First off, we really highlighted how investing in 2 to 4 unit properties can be a fantastic way to start building that long-term wealth, right?
Exactly. It's a manageable entry point, especially for those who might feel overwhelmed by larger investments.
And then there's the cash flow potential. I mean, having multiple units means more rental income, which can really help cover your mortgage and other expenses.
Right, and we talked about the importance of location too. Finding areas with growth potential can make a significant difference in your investment's value over time.
Not to mention, we touched on the value of doing your due diligence. Understanding the local market and property condition can save you a lot of headaches later.
Definitely. And let's not forget the flexibility you gain. Whether you want to live in one unit and rent out the others, or have it all as an investment, the options are really appealing.
It's all about finding what works for you, isn't it?
Exactly. Real estate can be a powerful tool for building wealth. It's about taking that first step, being patient, and making informed decisions.
Speaking of which, we'd love to hear from you. If you enjoyed this episode, please like and subscribe. And feel free to comment your biggest takeaway or any questions you might have.
And don't forget to share this with someone over 40 who might be thinking about investing in property. You never know who could benefit from this advice.
Next time, we're diving into commercial real estate for residential investors. It's going to be an exciting discussion.
We'll explore how those concepts can really open up new opportunities for you.
Thanks for joining us today. We look forward to seeing you next time.
Take care, everyone.
Bye for now.